Good morning, and thank you to everyone for joining us this morning for our webinar on revisions to the India-Mauritius Tax Treaty. Today we will be discussing these amendments to the Double Taxation Avoidance Agreement between India and Mauritius and look at how this will affect UK businesses investing in India. Before we begin, I'd like to familiarize you with the toolbox on the right-hand side of your screens. So that you're aware, we will have everyone on mute during the course of the webinar to keep any background noise to a minimum. If you do have any questions, please drop it into the little bracket on the toolbox to your right in the Please type your question here section, and we will take it up during our Q&A session at the end. On our webinar today, you will hear an overview from our expert, Mr. S.R. Patnaik, who is a partner at Cyril Amarchand Mangaldas and heads the tax practice. Mr. Patnaik has expertise in various aspects of direct tax, such as international tax, transfer pricing, corporate tax, and so on. He also has experience and expertise in various inbound and outbound M&A transactions. Recently, he won the Tax Lawyer of the Year Award in the Asian Lawyers Emerging Markets Awards 2015. I would now like to welcome Mr. Patnaik for his insights on the revisions to India-Mauritius Tax Treaty.
Thank you, and good morning, friends. In the next few minutes, we will discuss briefly about the recent changes to the India-Mauritius Double Taxation Avoidance Agreement and how would it impact investors coming from various jurisdictions, including the UK, because we have seen instances where many investments have been routed through tax-friendly jurisdictions like Mauritius to claim the benefits available under the Double Taxation Avoidance Agreement, which no longer would be the option available with the investors. So just to put things into perspective, the India-Mauritius Double Taxation Avoidance Agreement has been in existence since 1983, though it actually gained popularity in the early 90s, and basically the significant impact of investments came to India in the early 2000s, and thereafter Mauritius has been one of the largest contributors to the Indian foreign direct investment regime, constituting approximately 33% of the total FDI that has come to India till date. The primary reason seemed to be the tax benefits available under the Double Taxation Avoidance Agreement, because otherwise, as you would be aware, Mauritius is a tiny country in the African region, though there is a very strong socio-political relationship that exists between the population of Mauritius and India, primarily because a large part of Mauritian population are from are actually persons of Indian origin. Of late, the treaty had been under constant scrutiny by the Indian regulators and tax agencies, primarily because there have been instances where it was seen that Mauritius was being used as a tool to avoid and evade taxes, and also is being used to send money back to India, which is whether it is the money ill-gotten wealth that is accumulated outside India, which is typically called as round tripping, or at the same time we have also seen instances, particularly in relation to some of the anti-corruption drives initiated by the Indian government. We've seen that a single post box address is being used to have 2,000, 3,000, 4,000 companies with the same people as director, acting as director for all these companies. And there have been a number of instances where Indian authorities saw that the kind of checks and balances that was expected from Mauritius level was not being applied rigorously, and therefore without any checks and balances, a number of unscrupulous investors were utilizing the Mauritius Treaty to make investments in India, which is something that Indian government was not very comfortable with. So in addition to that, there have been a few other additional beneficial provisions that existed in the India-Mauritius Tax Treaty, which also made it even more popular for the investors to use it as a routing jurisdiction. The protocol that was finally signed on May 10th of 2016 has been under negotiation for a number of years by now. India had been requesting the government of Mauritius to come up with some additional stringent measures so that only such investors who are entitled to the benefits should be given the benefits, and there should be adequate substance being created out of Mauritius. So that was being registered by Mauritius, understandably so, primarily because a number of these investors would have used Mauritius primarily because of the tax benefits, and if Mauritius were to impose additional restrictions, then such investors might not be looking at Mauritius so favorably. And due to the resistance from Mauritius, the negotiations have been ongoing for quite some time, but they could not come to a mutually acceptable solution. And lastly, through this protocol, both countries seem to have reached a consensus in terms of what are the checks and balances that Mauritius needs to put in. It also signifies the strength and the belief of India that we do not need to provide tax benefits to the investors to come and invest in India, because the India story or the India internal business requirements are business offerings are such great of such great significance that no investor can today ignore India. So let me give you a very brief snapshot about the key features of the protocol. The first and foremost and the most important change that has been brought about through the protocol is the exemption from capital gains from alienation of shares have now been made taxable. So a Mauritius investor who was investing in the shares of an Indian company, at the time of his exit, the gains made by such investor would now be subject to tax in India. Now, there are some additional protection that has been given in relation to investments that have already been made on or before the signing of the protocol, and then we have also got some additional timeline till 31st of March 2017, which we'll discuss a little later. The other important change has been to introduce a tax on interest income. Now, under the erstwhile double taxation avoidance agreement, India used to tax interest income at the maximum possible rate as provided under the Indian domestic tax laws, and only Mauritius-based banks were exempt from from payment of taxes on their interest income. Now, what the protocol does is it takes away the exemption given to Mauritius-based banks, but at the same time, very helpfully, it actually allows the same concessional rate of taxation being offered to all investors who are investing through Mauritius. So therefore, any debt investor coming through Mauritius today, so long as the beneficial ownership can be held to reside in Mauritius, would now suffer a tax of only 7.5%, which is the lowest ever tax rate being offered on interest income by India in respect of all the treaties that it has signed till now. We have also been provided with a revised definition of permanent establishment. Earlier, the service fee clause, which is predominant in most of the treaties signed by India, was absent in the India-Mauritius Treaty, which has been brought about. We have also got a fees for technical service clause being introduced into the treaty, along the lines of what we define as fees for technical services under the Indian Domestic Act. The exchange of information provision have been tightened up significantly, and now it is in line with the international standards. And there was also, I would say, certain amount of loophole that was there in the other income provision in the treaty, which has now been capped. And now even the other types of income which were not specifically dealt with under any of the other articles would now be subject to tax in India if the source of that income is based in India. So now let's get into a little more in detail in respect of the changes that have been brought about through the protocol. So, as far as capital gains is concerned, just to clarify, India had granted India had given up its right to tax capital gains as far as investors who were investing in Mauritius. Now, that benefit has been kind of taken away through this protocol, and now any investor who's investing into India using Mauritius as a intermediary jurisdiction would now also have to pay tax just like any other investor. However, this provision would be applicable only in respect of shares acquired on or after 1st April 2017. And all investments made till 31st March 2017 would be grandfathered. In other words, the benefits that are available in relation to Mauritius-based investors right now, prior to the signing of the protocol, would continue to be available in respect of investments made by them till now, and the investors proposed to be made by them till 31st March 2017. The treaty or the protocol also provides for a transition period linked benefit in respect of all investments made from 1st April 2017, and in case such investor wishes to exit the investment prior to 31st March 2019, such investors would be entitled to pay tax only at 50% of the tax that is otherwise payable by other investor as per the Indian domestic tax provisions. And in order to avail this benefit, however, such investors shall have to comply with what we typically call it as limitation of benefit or LOB provisions. And those LOB provisions have also been clearly spelled out in the protocol itself. So the conditions provided under the protocol are that, one, you need to satisfy the primary purpose test, which means that when you are making an investment into India using Mauritius as a jurisdiction, you should not be using Mauritius only to avail the treaty benefits. there should be some additional business rationale that needs to be built in before you could, claim such benefits that are available under the treaty. And after you satisfy the primary purpose test, you also need to ensure that the investor from Mauritius is neither a shell entity nor a conduit entity. Now, if in order to qualify or in order to treat yourself as a, as not a shell entity, but an entity with substance, you need to ensure that you spend at least 1.5 million Mauritian rupees or 2.7 million INR in Mauritius during the preceding 12 months from the date on which you earn the capital gains. In other words, if suppose you have made an investment on, say, 1st of June 2017 and you want to make an exit, say, anytime before 31st of March 2019, you would otherwise have to pay capital gains tax at the rates specified under the Indian tax treaty. However, if you have spent more than 1.5 million Mauritian rupees in Mauritius in relation to your operations in Mauritius, and you satisfy the primary purpose test, then you do not have to, shell out the full rate of tax. Instead, you are entitled to pay tax only at the concessional rate of 50%. Now, here there are a couple of issues which need to be kept in mind. One, what is a primary purpose has not been defined either under the erstwhile treaty or under the protocol, and therefore this again will have to be something which probably has to be examined on a case-by-case basis by the Indian judiciary, and till such time we get some guidance from the judiciary, we will have to apply our own sort of understanding to the issue and ascertain whether or not I am entitled to this benefit. The other aspect is what constitutes bona fide business activities. Again, is something which will probably be addressed over the next few years. The next point which is of importance now is the taxability of interest income. As I said earlier a little while back, under the India-Mauritius tax treaty, India taxed interest income at its full maximum rate under the domestic laws, and the treaty was not giving any benefit to the Mauritius-based investors. The only exception being Mauritius-based banks. Now, the exemption to Mauritius-based banks have been withdrawn, but simultaneously, the benefit of a concessional rate of taxation being 7.5% has been extended to all types of investors, including Mauritius-based banks. And Mauritius-based banks have been given this benefit over an extended period in respect of all debt claims that were existing prior to the introduction of this provision. And so all debt claims that are there till date and will be there till 31st March 2017, the Mauritius-based banks would continue to be exempt from the interest income that they receive. In respect of all other investors, the applicable tax rate for such interest income would only be 7.5%, which, as I mentioned a little while earlier, is the lowest that India has offered in respect of all the tax treaties that it has signed till date. And the Mauritius banks would need to continue undertaking bona fide banking business to avail this benefit. And as per Indian laws, which is applicable in relation to all types of income, any income which is otherwise held as chargeable to tax in India, the income would suffer withholding at the time of the remittance of such income to the Mauritius-based investors, which is also going to be applicable in respect of interest income as well. Now, the next point is service PE. Now, as you would be aware, India is a developing country, and we follow a mixed base of residence-based taxation as well as source-based taxation. And service PE has been predominantly found in most tax treaties signed by developing countries, because in most cases, from experience, what we have seen, that developed countries send their people and personnel to India to render certain services, and therefore India believes that it requires to collect tax in respect of the income earned by the service provider from Indian service recipient on source basis taxation. And therefore, most treaties that India has signed has a service fee provision that typically states that if the employees and other personnel are physically present in India for a period, depending on whether that's a related party transaction or an unrelated party transaction. So depending on the personnel being present in India for either 30 days in respect of related party transactions, or for 90 days in respect of unrelated third-party transactions, the service provider would be deemed to have created a permanent establishment in India, and therefore any income attributable to the activities of such permanent establishment shall be taxable in India. And in Mauritius did not have the service fee clause, and now we have got the service fee clause in the India-Mauritius tax treaty, and hence all Mauritius-based entities who were receiving service income from India would now have to pay tax in India in case the employees and other personnel of such Mauritius-based entities spend more than 90 days in India. The next change in relation to the double taxation avoidance agreement is the introduction of fees for technical services. Again, India being a developing country always tries to get its share of taxation on the basis of its claim that the source of the income is located in India, and therefore if a foreign entity receives any fees for technical services from an Indian payer, such non-resident is required to pay tax in India on source-based taxation at the gross rate of 10% as per the Indian domestic tax provisions. And most of the tax treaties signed by India have also gotten a clause for dealing with the taxation of fees for technical services. However, Mauritius was one of those exceptions which did not have the fees for technical services or FTS clause. Now the protocol introduces the FTS clause into India-Mauritius double taxation avoidance agreement, and therefore henceforth if a Mauritius-based entity receives any income in the nature of FTS from an Indian source, such Mauritius-based investor would now be liable to pay tax in India. And the tax would be payable on gross basis at the rate of 10% on the total amount of fees payable to the Mauritius entity. The next change is in relation to other income. We had a other income provision already in the India-Mauritius tax treaty, However, the manner in which it was drafted was giving an escape route to the Mauritius-based entity, because it said if there is any other type of income which is availed by the Mauritius-based entity without and that the nature of income is such that which has not been specified in any of the other clauses, then such income can only be taxed in the country of residence. Effectively meaning thereby that if a particular type of income is not covered under any of the other provisions of the treaty, then India lost its right to levy tax in respect of such income. Now that has been plugged, and now we have a residual clause which has been introduced into the India-Mauritius DTA, which now requires that if you are earning any income from India, and if such income is not specifically dealt with in any of the erstwhile clauses of the or articles of the treaty, even then India will have the right to levy tax in respect of such income. The other important change that has been brought about through the protocol is the exchange of information and assistance in the collection of taxes. These are more to do with some of the taxpayers who were trying to raise the issue of extraterritoriality and therefore not trying to pay tax, or people who have actually taken money out of India and subsequently tax claims have been raised against them. They were not forthcoming with those taxes, and India did not have a right under the treaty to actually request Mauritius to now assist it to collect the taxes, which is now being introduced in terms of a specific provision in the through the protocol, and the manner of exchange of information clause has also been bolstered with additional provisions, and now it is in line with international standards, and therefore Mauritius can rather India can now request Mauritius to provide all requisite information that it requires to take the cases to the logical conclusion. Now these were the primary changes that were that were brought about through the protocol. In the next few minutes, what we could quickly discuss is the impact of such changes. This impact has come in primarily to prevent people from using Mauritius only as a jurisdiction to avoid or evade taxes, and what we typically call it as treaty abuse, and also to ensure that there is no round tripping that takes place, primarily because a lot of Indian money where it is alleged by the Indian tax authorities that a lot of Indian money is being routed through Mauritius and being brought back to India, primarily because of the tax benefits that Mauritius provides to India, which gave rise to a significant amount of heartburn in the minds of honest taxpayers as well as tax administrators, because people who were avoiding or evading taxes and taking money out, they could again legitimately bring back that money back to India because of the lack of supervision and lack of substance requirements in Mauritius under Mauritian laws. This is going to impact the investor sentiment for a short period, but over a period of time, I think because of the manner in which the changes have been brought about, like giving a adequate advance notice to the investors and also providing a transition period related taxation mechanism for investors who are planning to invest through Mauritius. And most importantly, Mauritius was one of the 3-4 jurisdictions that used to extend this benefit to the investors. Now, after this benefit has been withdrawn from Mauritius, the other jurisdictions which were granting similar benefits are also likely to lose such benefits, because as per public information and statements made by various politicians as well as senior government bureaucrats, it seems that India is now going to renegotiate similar tax treaties that India has with other jurisdictions as well, and therefore it would be a level playing field for investors coming from all jurisdictions, and nobody would have to route their investments through a Mauritius or through another tax-friendly jurisdictions to get the tax incentives. Whatever tax incentives that India intends to offer would be offered to all foreign investors on an equal basis. So this is of importance because a UK-based investor tomorrow does not have to route its investments through Mauritius just to avail some tax benefits, because if the investor is entitled to the tax benefits, that benefit would be extended direct even if you invest in India directly. Now, coming back to some of the specific segments, in respect of strategic FDI investments, tax typically does not become the determinative factor, primarily because the strategic investments are made with a long-term objective in mind, and the very strategic nature of such investments are decided after a significant amount of research by the investor with regard to the market conditions in India and what is the market that India would offer to the requisite products that are being marketed or manufactured through that vehicle. And therefore, tax though plays an important role, but is not the single biggest factor to decide how to make a strategic where to make a strategic investment and how to make a strategic investment. And therefore, in our view, the strategic investments may not really be impacted through the on account of this protocol. However, I can't say the same thing about private equity and venture capital investments, because they are primarily, at least what we have seen in India till date, most of the private equity and venture capital investment have been mere financial investments with a very short-term objective in mind to provide adequate amount of returns to the investors. And therefore, tax plays a very critical role, because if you lose out 10 to 20% of your returns towards taxes, then the returns to your investors also go down significantly, especially when you are earning only a marginal rate of return on your investments. And therefore, such PE and VC investors would now think twice. However, since India is one of the fastest growing large economies in the world today, and many factors go in favor of India because of our demographic status. We have a fairly large young population. We have a huge marketplace for all types of products. We have an aspiring middle class who wants to use the best-in-class technology, best-in-class products, and we are willing to pay a price for that. So the market intelligence, the marketplace that India offers is probably second to none in today's time, and therefore many PE investors and VC investors would continue to treat India as a very good investment jurisdiction, in spite of no capital gains benefit being available henceforth, primarily because of the sheer amount of return that India could offer on their investments. So while it would have some amount of impact, but I foresee that the PE and the VC investor community will continue to look at India in favorable terms. Now we'll talk about some specific types of instruments, how it is going to be impacted. I'm sorry, I would be going a little technical here, primarily because the protocol deals only with shares of Indian companies. Now, as you would know, many investors in India, they invest into Indian entities through different instruments, whether it is a convertible preference shares, whether it is a convertible debentures. Now, somehow, interestingly, the protocol does not deal with any other type of instrument, and therefore a question that has arisen is what happens to the other types of instruments, whether transfer of such instruments would continue to continue to avail the tax benefits, or it would be available only in respect of shares. Now, the plain reading of the protocol seems to suggest that the benefit that has been withdrawn is only in respect of shares of an Indian entity, and therefore if you are a foreign investor based out of Mauritius and you are invested in say compulsorily convertible debentures or CCDs, then the transfer of CCDs will continue to be tax exempt from India, in India. Now, long-term capital gains of listed securities are anyways tax-free in India as per Indian domestic norms, and therefore the treaty does not provide any additional tax benefit. However, if it is short-term, then India levies a tax of 15% in respect of such income. However, if you are coming from Mauritius and you are earning short-term capital gains because you have held the shares for a period of less than 12 months, then instead of paying tax at the rate of 15%, you would now be required to pay tax at the rate of 7.5% till 31st March 2019, subject to your complying with the limitation of benefit clause. However, if you are an unlisted share, then typically today a foreign investor is required to pay tax at the rate of 10%. If you have been holding the unlisted share for more than 24 months, now that tax rate would continue to be available, primarily because all investments made on or before 31st of March 2017 would anyways be entitled to claim the benefits that is there under the present tax treaty. In respect of the future investments, anyways you won't be able to claim long term because the investments would be held for less than 24 months till 31st March 2019, and if you exit post 31st March 2019, then you are not going to get any concessional tax treatment, because post 31st March 2019 you're not entitlement to the tax treaties. So now one of the other issues that is critical is what happens post introduction of general anti-avoidance regulations, because India is going to have introduced the GAAR provisions with effect from 1st of April 2017, and therefore it is going to be interesting to see the interplay between GAAR and double taxation avoidance agreement. Whether the latest changes in the interest income element would bring about a surge in debt related investment, I would think so, for at least in the coming days, primarily because investors who have already invested through Mauritius, they probably would continue to use it, because Mauritius, while it withdraws the tax capital gains benefit that was otherwise available, it definitely does not impose any additional restrictions or additional taxation. And most importantly, as I discussed a little while earlier, in respect of interest income, now Mauritius would actually gives the most beneficial tax treatment to the interest income. We are running out of time, so we will now probably request you to raise any questions that you may have in respect of whatever we have discussed till now. The one quick point before I conclude, before I open the forum for question and answers, would be that, as I said earlier, most of the treaties are undergoing renegotiation, which especially those treaties which offer similar benefits for capital gains, like Cyprus, Singapore, Netherlands. India has already started renegotiating these treaties, and it is expected that most of those treaties would also sort of withdraw the capital gains benefit that was provided under those treaties. So it remains to be seen whether Mauritius and jurisdictions like Cyprus and Netherlands would continue to remain attractive for foreign investors, or it's going to be mostly driven by business exigencies, wherein, say for example, certain private equity funds like who are India focused funds, they anyways need a pooling vehicle, and that pooling vehicle can continue to be in Mauritius, or whether those vehicles also will shift jurisdiction and now be set up in other jurisdictions. It will be interesting to see. Now please feel free to raise any questions that you may have. Thank you.
Many thanks for that excellent overview, Mr. Patnaik. I will now ask some questions we received. The first question is, does the change on capital gains provisions apply only to shares, so that capital gains in relation to notes and debts continue to apply?
As I briefly talked about in the presentation, the protocol deals only with shares, and the residual provision under the capital gains provision, which is there in terms of Article 13(4), that still continues to suggest that if any other type of capital gains is earned by a tax resident of Mauritius, only Mauritius has the right to tax such gains, which in effect means that if you are an investor based out of Mauritius and you have invested in instruments other than shares, then you will not be liable to pay tax in India even after 1st of April, even in respect of investments that you make on or after 1st April 2017. In other words, the capital gains exemption will continue to be available based on the literal interpretation of the protocol as it stands now, unless India again tries to renegotiate this provision with Mauritius in the coming days, weeks, weeks. Thank you.
Thank you. The next question is, what is the CGT on debt claims post March 2017?
As far as debt claims are concerned, again, typically the returns would be either from transfer of these claims or the interest income that you derive. So if you are a foreign investor investing through Mauritius, then I assume you won't be, and you are not a Mauritius-based banking organization, then as of today, the interest income was taxed at 40% plus surcharge plus cess, which would now be taxed at the rate of 7.5% plus surcharge plus cess, which effectively would mean about approximately 8% on a going forward basis. If it is in the nature of capital gains, then as I said a little while back, since it has not been captured in the protocol, we can continue to claim that the capital gains from transfer of debt claims would continue to be tax exempt in India.
Thank you. The next question is, what is the treatment of bonus shares and shares acquired on conversion of CCPS, assuming underlying instruments were acquired prior to April 1, 2017?
This is a very interesting question. Bonus shares, I think while there is a case that can be made out that since the investment was made prior to 31st of March 2017, all bonus shares issued, again, if the bonus shares are issued prior to 31st March 2017, then again it's a non-controversial position, that is you will continue to avail tax benefits. However, if the bonus shares are issued after 31st, meaning on or after 1st April 2017, but the original investment was made prior to 31st March 2017, while a case can be made out that since the investment was made prior to 31st March 2017, therefore the beneficial tax treatment should continue even in respect of bonus shares. I suspect the tax authorities are going to take a different position. They are going to say that the bonus shares are a separate instrument, and since they are allotted subsequent to the prescribed date under the India Mauritius under the protocol, that is 1st April 2017, therefore the benefit may not be available. However, it is a matter that is, I'm sure there are tax payers who are going to take an aggressive position on this point, and it will ultimately have to be decided by the courts as to what is going to be the treatment.
Thank you. The last question is, many investors are anxious and are in a rush to make investments through Mauritius and Singapore before 31st March 2017 to avail the capital gains exemption till it is available. What are the chances for these investments and structures to be questioned under GAAR?
That is always a risk and exposure that one has to carry, because the GAAR provisions have been announced some time back, and they have been deferred a few times, and the fact that it is going to be implemented with effect from 1st of April 2017 is well known amongst the investor community, and this has also been reconfirmed by the Indian Finance Minister during the budget presentation this year. So if anybody is making an investment on or before 31st March 2017, My personal belief is, since the treaty provides a leeway and treaty provides this exemption, and the protocol also very unequivocally states that all investments made on or before 31st March 2017 should be entitled to the treaty exemption. I see no reason why the GAAR should be invoked, at least in such cases. But it also remains to be seen how aggressive Indian tax administrator wants to be with regard to implementation of GAAR, because if you look at the other jurisdictions which have implemented GAAR, they have been extremely cautious in terms of invoking GAAR provisions in relation to foreign investors. But Indian experience has been a little different, be it in terms of transfer pricing and be it in terms of other anti tax evasionary mechanisms that have been brought in. So it would depend on 2-3 factors. One, whether the government believes that they would try to bypass the treaty by invoking GAAR. Number two, how aggressive the government wants to invoke and implement GAAR in the coming days. And three, whether they are going to necessarily do a treaty override by invoking GAAR in each and every situation, or they would invoke GAAR only in the rarest of circumstances, which is what I would expect and hope for.
Thank you very much, Mr. Patnaik, for that excellent overview and interesting insights. Thank you for your time, and I hope this webinar was valuable to you. If you have any feedback or comments about today's session or a session that you'd want to see us do in the future, please feel free to get in touch. Thank you for joining us.
Thank you. Thank you so much.